The debt trap. Is the US losing its economic power? Picture this. The world's largest economy is standing on the edge of a financial cliff, with its debt climbing higher by the second. Every tick of the national debt clock pulses like a warning bell. How did the land of opportunity spiral into this debt trap? To unravel today's predicament, we must travel back to the aftermath of World War II, a time when America seemed invincible. In 1945, the United States emerged from World War II not just as a victor, but as the undisputed economic powerhouse of the world. The post-war boom saw the nation accumulate enormous gold reserves and a strong industrial base. The national debt back then was modest, totaling about $236 billion. But it wasn't long before this status would lead to increased spending as prosperity gave rise to ambition. But everything changed when the Cold War reared its head, and our spending habits evolved dramatically. The Cold War led to a series of military engagements around the globe, from Korea to Vietnam. Each conflict pushed the debt higher, as wartime expenditures strained budgets, often financed through borrowed money rather than raised taxes. By 1980, the national debt had skyrocketed to nearly $1 trillion, a staggering figure at the time. However, it wasn't just wars that sent the debt soaring. The social programs initiated during the Great Society era also left a significant mark. Domestically, the 1960s and 70s ushered in expansive social programs aimed at education, healthcare, and welfare. While these programs aimed to uplift Americans, they added substantial costs without equivalent revenue. Fast forward to the early 21st century, when the economic landscape would again be shaken. What could possibly cause even more financial upheaval? Enter the era of financial crises. The dot-com bubble burst in the early 2000s, followed by the catastrophic 2008 financial collapse. Each crisis necessitated massive government bailouts and stimulus measures designed to keep the economy afloat, while the national debt soared to over $10 trillion. Then, just as the dust began to settle, the world faced a new crisis: the COVID-19 pandemic. The pandemic landed like a freight train on the global economy, forcing a seismic shift in fiscal policy. In response to COVID-19, the U.S. government unleashed unprecedented spending measures, stimulus checks, expanded unemployment benefits, and more support for businesses. This fiscal response, while necessary to prevent economic collapse, pushed the national debt beyond $31 trillion. But as debt exploded, a crucial question emerged. Why has the US dollar remained the world's dominant reserve currency despite this mounting debt? Historically, the US dollar's supremacy has stemmed from a blend of economic and geopolitical factors. After World War II, the Bretton Woods Agreement established the dollar convertible to gold, inherently tying global trade to U.S. economic stability. Even after the gold standard was abandoned in the 1970s, the U.S. continued to foster trust through strong institutions, innovation, and military strength. Yet we're entering uncharted waters. The U.S. dollar accounts for nearly 60% of global reserves, but simmering forces are nudging potential challengers to the forefront. Could the rise of China and new economic alliances signal the beginning of the end for dollar dominance? China's rapid economic growth has propelled it into the spotlight. The Belt and Road Initiative exemplifies its ambition to carve out a significant role in global trade through infrastructure investments. Furthermore, the formation of BRICS, Brazil, Russia, India, China, and South Africa, established an alternative bloc that seeks to diminish reliance on the dollar. Together, these nations are working on systems for trading in their currencies. As countries explore alternatives, we must also consider the psychological dimension of investor confidence. The U.S. has long been considered the safest harbor for investment, but growing debt levels could erode that perception. What happens when investors begin to question whether America can sustain its mountains of debt? The ramifications could be devastating, leading to a potential sell-off of U.S. Treasury bonds and ultimately higher interest rates, making borrowing even more expensive. But let's reflect for a moment on what this rising tide of debt really means for ordinary Americans and the global economy. If the U.S. fails to rein in its national debt, Americans could face severe implications. We might see cuts to essential services, reduced social programs, and increased taxes. Furthermore, should the dollar lose its reserve status, global markets could experience chaos, leading to increased costs for imports, a decline in living standards, and turmoil in global trade. So, what's the way forward? The path may not be straightforward, but understanding the stakes is crucial. Debate rages within Congress about fiscal responsibility versus the need to spur growth through spending. Both sides must weigh short-term gains against long-term sustainability. Our society stands at a crossroads where choices made today will shape not only America's future, but that of the entire globe. As we navigate these turbulent waters of debt and national power, one question looms large. Can America reclaim its footing, or are we witnessing the slow unraveling of a financial titan? We want to hear from you. What do you think will happen to the U.S. economy in the coming years? Share your thoughts below.